Hello, thank you so much for taking a few moments to look at my programs and look at my slide sets here. On this slide show, what I'm going to do, I've added just a brief audio file here just to sort of guide you through some of the evidence here, give you a flavor of the story that I can present to your audience. Really, all of my programs come out of this work that I've done over the last few years. That really just sort of led me accidentally to a new sort of paradigm, a new viewpoint of how to look at the housing bubble and the financial crisis and understand exactly what's happened. The story ends up coming to so many new conclusions and sort of putting its fingers into so many different things that we need to think about in terms of real estate brokers, the home building sector, just in general, the asset managers or real estate investors. There's so much here for everyone to learn. What I really want to do here is just sort of introduce you to the basic underlying empirical evidence that I've discovered. And I think you can get a sense of where we can go from that. For your particular audience, we can do anything from a short keynote speech or lunch speech that's an hour or less, anywhere up to an all afternoon or all day workshop that gets more into the meat and potatoes of the empirical evidence I have. The details and the data and the charts I have here are really just a small part of the fuller story that we'll be developing and getting out there and marketing later in 2018. But first, what I would like to do here is just start with some basic graphs and kind of lead you through what led me to tell this new story of what's happened. This first graph is sort of the basic story that we all sort of came to understand and led us to the conclusions that we've had thus far about what happened. This is a graph that compares, this red line here compares the number of new one-family houses that were sold over time. And we see that bump there from the late 90s till 2005. And then also at the same time, the blue line here is a measure of price to income in the housing market. The median price of a house compared to the median income of a household. Both of these things rose at the same time. All of this seemed very convincingly like it was a signal of too much credit, too much money, too many houses, too much building. Everything seemed like a sign of excess, and that's the conclusions we sort of went running out of the gate with as we entered the end of the bubble. What I've discovered is looking back and looking a little more deeper at all of these, everything that was happening, what I've discovered is that actually we got it 180 degrees wrong. Prices can rise for two reasons, really. Prices can rise because there's more money or more income or more credit available for a certain asset class. But prices can also rise because there's not enough supply. This is basic supply and demand, right? What I've discovered is that prices actually rose because we've had a shortage of housing going back at least 20 years, especially in a handful of cities, which I call the closed access cities. It's New York City, Los Angeles, Boston, and San Francisco. These are cities that have a character in their local economies and in their housing markets that simply doesn't look like anything else in the country. And first and foremost, it's defined by a severe lack of new housing. So those cities were driving what we call the housing bubble, and it was the lack of housing in those cities that was driving it. And so credit markets were sort of just along for the ride. And so as we go through here, so for instance, this first graph is just a national measure of the number of homes that we had in the country. The orange line is per capita. The red line is per adult. What we can see is both of these had peaked back in the late 80s and early 90s. Neither one of them was at an unusual level by the time we got to the top of the housing bubble. Housing units per adult was actually a little bit low the level that we saw in the late 80s and early 90s. There was a slight rise in the number of units during the housing bubble, but it was hardly out of the ordinary. And any census data we look at in terms of the flow of new housing stock, when we take account of all the different types of housing, everything that can add to the number of units that we have in our national housing stock, it just doesn't add up to anything that you would have considered to be an obvious oversupply. Now, partly what's happening here is that multi-unit building, which you would see happening in places like Los Angeles and New York City and San Francisco, has been severely restricted. So a lot of the housing starts, a lot of the activity in housing starts was in single-family homes built for sale. That's the only category that was growing. All the other categories have been stagnant or in decline because of this housing supply problem that's focused on these urban centers. Now, of course, since the crisis here, we can see that especially in housing units per adult, we've just been in a free fall since then. So this graph, what I've done now is instead of looking at the national level, I'm looking at the metropolitan area level. Along the x-axis, we're looking at rents. This is the median annual rent for a housing unit in each metro area, and the y-axis is the median home price in each metro area. I've got 3 points in time here. 1991 is in green. That predates the supply crisis. So in 1991, rents and prices across the country didn't vary that much from city to city. What we see by the time we get to 2007 is that we have these outlier cities, and the outliers are San Francisco, San Jose, Los Angeles, New York City, Boston. It's these few cities where what we have is that these are the cities sort of at the forefront of the post-industrial economy. Incomes are high in those cities, incomes are rising, but those cities are incapable of allowing their housing markets to expand to accommodate this the households that would like to move there to tap into these lucrative these lucrative labor markets. They could, this is a political issue, they could allow more housing to be built, but they don't. The fact of the matter is they don't. So what happens is households that can tap into the labor markets that exist in those cities, where those cities have some sort of, capture of a certain industry like the tech industry in San Francisco or the banking industry in New York City. Households move into those cities, workers move into those cities, and they have to bid up the rents of the housing stock until rents are high enough to basically push somebody out the bottom that can't afford to stay in the city anymore because of the rising housing costs. So at its base, we need to stop focusing so much on prices as the measure of affordability. Prices are one measure of affordability, but at its base, the most important measure of affordability in housing is the rental value of a home. That's really what determines whether you can afford to be a tenant or not. It's a secondary question as to whether you can afford to be an owner or not. But at its base, we all need to be able to afford to be tenants. And it's the cost of being a tenant, whether you own or rent in those cities, that's the fundamental driver of the rising prices that led to the housing bubble. So we can see here in 2007, it was rising rents that made those cities outliers. And then secondarily, prices reacted to those rising rents. So prices were high in those cities also, but it was a function of these rising rents. Now, because we didn't solve the housing supply problem, we tried to solve it by limiting credit. We basically had a housing supply problem, and we tried to solve it with a credit supply problem. So we have brought down prices somewhat in the years since then. But if we look at the red dots here, which are 2015, these cities have only become more outliers because we haven't solved the basic supply problem. So rents have continued to rise, and especially rise in these outlier cities. So at any point during this period, during the boom or bust, it's rents that are the core feature here. Even in 2007, when we thought that it was a reckless credit market that was creating rising prices, even at that point in time, rent was a much more important factor in the price level of houses in a given city than it had been in, say, 1991. So if we look at individual cities now, over time, what I've done here is graphed the housing market across Atlanta and Seattle with 5 quintiles from taking every zip code in each city and dividing those zip codes into 5 quintiles from the lowest price zip codes to the highest price zip codes. So what we can see here is that one of the signs that researchers used to conclude that credit markets were the causal factor in the housing bubble was that in a handful of cities, home prices rose more at the low end than they did in the high end. They concluded that that must have been because there was new credit available in low-end housing markets that was pushing their prices up higher, and that was taken as a strong sign that credit markets were the causal factor in the bubble. That only happened in a very few cities, and it happened in the cities like New York City, LA, San Francisco, and Boston. Now, this is a topic that we could spend a lot of time on, and I'm not going to go into it here. This is one of the things we could talk about on a more extended program. But here I will just point out that those cities, the cities that had that signal, where low-end prices were rising more than high-end prices, those were the cities that had hundreds of thousands of households moving away, mostly households with low incomes, because of rising costs. If credit supplied to those households was creating the housing bubble, you wouldn't see a massive migration event of those households leaving those cities. You'd see a massive migration event of households moving into those cities to buy the high-priced homes. But households with low incomes are an insignificant part of those housing markets because those cities are so expensive. A middle-class or lower-middle-class household simply can't afford it. Now, what caused prices in places like Phoenix, Arizona, Nevada, inland California, and Florida to rise? Because those are places that generally do have more elastic housing supply. What made those places different from the rest of the country was that they were taking on the major wave of that migration out of the closed access cities. So all these households were moving out of those cities, and they were searching for cheaper housing. They were trying to lower their housing consumption. They were trying to lower their housing costs. And so the first wave, the waves coming out of coastal California were coming into inland California and Arizona and Nevada. And eventually they swelled into those cities at such a rate that they overwhelmed even those cities that had generous lending policies or generous building policies. And what those cities actually had was a migration event. And again, that's details that I'm not going to get into in this short introduction. Again, that's another thing that we can really go into details on in a longer program. But here what I want to show you is that in most cities, that signature of high-priced versus low-priced homes never happened. High-priced and low-priced homes rose and fell together throughout the boom and bust until mid-2008. There actually is no signal in most cities of any sort of credit push. Now, what happens? So when we look at the relative price changes over time, what a lot of researchers will do, they'll say, well, from the beginning of the boom till 2006. There were some cities where prices at the low end rose at the same rate as prices at the high end. But if we look at the period from 2006 to 2012, prices at the low end fell a lot more. So their conclusion, because they're operating on this presumption that credit was the cause of the boom, their conclusion is, oh, well, we must have overbuilt. We must have been lending too much money to buyers in cities that had elastic supply, so we overbuilt in those cities. So the prices didn't rise during the boom, but then when it inevitably collapsed, then prices fell more because there was an oversupply, right? Well, for starter, firstly, there was no oversupply anywhere. Secondly, if you look at the timeline more closely, what you see is there was still no, even in the first half of the bust period, from 2006 to mid-2008, there was still no separation in prices. And housing starts had started to collapse by early 2006, right? So we're well into the period here where you would start to see the ramifications of having oversupply. The subprime market had collapsed by mid-2007. So everything is happening at this time where we should see the effects of oversupply, but we don't see that. What we do see is two specific points in time where you can very clearly see the deviation in the different housing markets in these cities. First, in late 2008, which is when the federal government took over Fannie and Freddie, and they tightened lending standards to extreme levels compared to any lending standards Fannie and Freddie had had before. For instance, the average FICO score of a borrower didn't really move much during the bubble, but the average FICO score of an approved borrower now at Fannie and Freddie is much, much higher than it had been before. Then in 2010, we passed Dodd-Frank and the Consumer Finance Protection Bureau. These two events were severe negative shocks to credit supply that we imposed because we had the wrong idea of what happened during the bubble. So we had a supply shortage, and now we've tried to counteract that with a credit shortage. And you can see very clearly, like if you look at Atlanta here, first the high-end and low-end prices deviate after late 2008. Then all the prices start to sort of level out again in early 2010. And then in mid-2010, when Dodd-Frank is passed, we see another downshift that especially affects the low-end houses. Now, there's no legitimate story you can tell about how a housing boom and bust, or how a housing bubble and bust would happen that would tell you that low-end home prices should have collapsed in mid-2010 because of oversupply. The thing that caused that to happen was our reaction to our false conclusions about what had happened during the bubble. We have imposed a credit crunch on working class homeowners in every city in the country. So during the bubble, what made the bubble was that places like Los Angeles were different than places like Chicago or Atlanta. It's the difference between those cities that made the bubble. The bust is different. Every city during the bust looks the same. In every city, working class neighborhoods got shellacked during the bust. It didn't matter if home prices had gone up there by 100% or 40%. And that's because we didn't actually reverse what had happened during the bubble. We created a new crisis. Here's just a couple more items to address the credit supply issue. This graph on the left is a measure that the Federal Reserve uses to, it's a measure of distressed borrowing. How many households have debt payments that are more than 40% of their incomes? The far left here is the average for all families, and then it goes from the lowest income households to the highest income households. The high debt payments, and this is from 2001 to 2007. So the shift to having high debt payments happened entirely among the households with higher incomes. They were getting large mortgages that took a large percentage of their incomes because they were the ones buying homes in places like San Francisco to get in, to bid their way into the lucrative labor markets. The bubble wasn't built on the backs of households with low incomes who couldn't afford mortgages. None of that increase in expensive mortgages happened at the low end of the market. The low end of the market was moving out of those cities trying to find cheaper homes in the rest of the country. Now, this graph on the right is a measure of lending by FICO score. So this is another measure by the Federal Reserve. I divided it here between 760 scores and above, which is the red line, and 760 scores and below, which is the blue line. For 760 scores and above, it's a flat line. Nothing happened. They were buying homes just like they always would during the boom, and they're buying homes just like they always would have during the bust. It's the bottom end of the market that we've cut out of the housing market, and that's caused foreclosures. That's caused home equity losses. It's wiped out savings of millions of families. Now, the level of lending to that group, the blue line there, that's the 760 below, there was nothing unusual about that during the boom. This graph only happens to go back to 2003, but there was nothing about the level of lending to those borrowers that was any different than it had been for decades before. when 2/3 of the country for decades had been homeowners, the average FICO score is a little under 700. So most households that are borrowers, that had been borrowers for decades in the housing market in this country, had FICO scores under 760. This was a normal part of the home buyer's market, and there was nothing about that market that really changed during the housing bubble. But we wiped it out. First you see a little bit of a downshift when the private securitization market collapsed. Then you see it continue as pressures put on Fannie and Freddie, and then they're taken over in late 2008. And from that point on, from late 2008 onward, we've simply killed that market. We've basically cut out the bottom half of the traditional American home buyers market, and it's focused on buyers with lower incomes. So the effect this has on affordability, right, is tremendous. So here I've taken the red line here is Zillow's measure of rent affordability, the proportion of the median household's income that is needed to rent the median house. Now that's been fairly level, but sort of was rising a little bit during the bubble because our problem has been a housing shortage. So rents were slightly elevated. Now when we matched that housing shortage with a credit shortage, that only destroyed the housing stock even more. That only made rents go even higher. So now rental affordability is at its worst level, the worst level than it's been for decades, if not ever. Now if we compare that to mortgage affordability, which is the blue line here, we need to make a couple of adjustments. One is that a mortgage payment includes an inflation premium, so that's why mortgage payments were much higher in the late 70s and early 80s, as you can see here. So we can make a very simple inflation adjustment to try to compare mortgage affordability to rent affordability. Then also, somebody with a mortgage also is responsible for the repair and upkeep of a home. So we need to add some measure of the cost of owning a home to that. And so making those two adjustments is what I've done here to get to this yellow line. So for decades leading up to the housing bust, mortgage affordability was right in line with rent affordability. Home prices in 2005 and 2006 were not out of line. The typical expense for a new home buyer was not any different compared to renting than it had been for decades. It's the period since then that we've created a disconnect. It's the period since then that homes have become very affordable. But at the same time, now that homes are as affordable as they've ever been, we've created these legal obstacles so that working class households can't get the mortgages to make this extremely profitable purchase. And you can see, in the difference between us and the international comparisons, you can see that in places like the UK and Canada and Australia, home prices have continued to rise from the mid-2000s because in those countries, prices are still equilibrating to, they didn't destroy their credit markets. So prices are rising until this difference between mortgage affordability and rent affordability levels out to its historic norms. Those are the countries that are normal. Now, the thing is that those high prices are happening because of low interest rates. And so this is one of the things we can, one of the lessons we can learn from this new way of looking at it is low interest rates aren't really driving home prices up. The causation is as much the other way. The fact that we've made so many limits to real estate investment to real residential investment, that's what's keeping interest rates down because savers have money they want to they have financial capital they want to transfer into physical capital, and we've developed all these obstacles that keep that from happening, and that keeps interest rates low. So one of the lessons we can learn is we shouldn't be afraid of rising interest rates. Real estate brokers or home builders, anyone in the real estate field shouldn't be afraid of the effect that rising rates will have on demand, because actually what's going to happen is the only thing that will make those rates rise sustainably is if we actually allow demand to recover. And this is just one more way to look at this issue. This is a long-term graph. This blue line is real yields on home ownership over many years. And we don't have a market measure of real long-term interest rates that goes back very far. It goes back to the mid-90s. But we do know that this picture basically looks like what we know real interest rates looked like in those years. We know real interest rates were low coming out of World War II. They rose into the 60s. We know real interest rates were low by the late 70s. They rose again in the late 90s. And now when we have this market measure of real interest rates for the period from the mid to late 90s on, we see that up till the end of the boom, housing yields and real interest rates were moving together like they always had, like they continue to be moving in some of the other countries like Canada and Australia. The disconnect here has been during the bust time. We've pushed prices in the housing market down through credit repression. So now yields on real estate are much higher than yields in treasury markets are, in bond markets. So what will happen if we ever find a way to heal, if we ever find a way to reverse what we've done and allow these markets to heal, we'll actually see these yields reconverging back in the middle again. So in a nutshell, there are many lessons to learn from all these new discoveries. We are in a boom and bust economy. People talk about that a lot. Why every time the economy starts to grow, why does it end up in some sort of asset price bubble? And the reason isn't because of anything the Federal Reserve's doing. The reason is anytime we have real economic growth, it's going to induce this bidding war to get into those closed access cities that won't build enough new homes. So any sort of economic growth will inevitably lead to a housing bubble as workers bid up their opportunity to move into those cities and tap into the post-industrial economy. So because the Fed gets blamed for this, this leads to hawkish monetary policy, which keeps growth too low and keeps inflation below the level where it could accommodate sort of optimal economic growth. And it's also created this false sense in real estate that especially markets at the low end are very volatile and risky, and we need to be careful about them. That volatility came from a one-time shock. What we'll actually see looking forward is that those markets will continue to produce high yields, or if we find a way to actually heal these markets and allow households in those neighborhoods to become homeowners again, that will boost demand in those markets, and the potential capital gains in the low-end markets are actually better than they've been. They're actually a safer, more lucrative position to be in than they had been in the past. So this is sort of a basic overview of the general story, and I hope you can kind of see how various audiences might find this to be of interest, or might find it to be compelling and something they can leave talking about, something that will affect the decisions they make professionally, whether it's having a new understanding as a real estate broker about the benefits they can bring to a household that has constrained credit access, and the ways we can find to turn those households into homeowners, as home builders, the sort of inputs we should have into our forecasts and thinking about what's going to change the market going forward. For investors, just in terms of the business cycle, in terms of Fed policy, in terms of how this is affecting inflation rates, how it's affecting how we would manage our asset allocations. There are a lot of audiences that I can focus this information on to sort of give them insights that especially affect their professional work. And I think for any audience, simply seeing this new framework with fresh eyes will be something that they'll find interesting, thought-provoking, something they'll leave the presentation talking about. And thank you for giving me your time.